Welcome to the Pump and Dump channel for another video, this time carrying out the transaction at the end of the day, as mentioned yesterday, selling Range Resources and buying Cab Oil and Gas. The price today was a bit unfavorable. Cabot went down about 2% over the course of the day. Range Resources went down almost 4%, so could have gotten more if I exchanged it on Friday, but it's the way it is. So here, of course, and I mentioned this with Cimarex and Cabot merging at a fixed ratio of 4.0146. It is important to note that Cabot, based upon that ratio, is undervalued relative to Cimarex. Like, it's kind of like as if Cabot Oil and Gas would have to rise to about 1740 or so, which is about 50 cents, to get onto parity with Cimarex, or Cimarex would have to fall to about just under 68, which is about a 2.8% differential between the two. And also the dividend on Cabot is a bit higher, and I think they'll pay out one, maybe two more dividends before the merger, and that is not much, but if you have huge amounts of money invested in it, then it can of course make a difference. But yeah, it's just choosing the right one. In terms of the risk profile, if the merger doesn't come to pass, I think these two companies would remain where they're trading at as long as oil and gas prices remain the same. But if they do merge, and that's highlighted in my target here, I think we have a potential of $27 a share. Maybe it's, prices move and it's only 22 or 23, 24, who knows, but I think between 20 and 27 is a reasonable expectation with the merger happening, with the cost savings that will come out of this, and also the reclassification of Cabot from a mature producer to a growth company. Of course, Range Resources is a growth company, and that's probably also the reason why from the March low it is up almost 10x. And yeah, that's just the way it goes. Sometimes you can buy something for $1 or $2 or $3, and later you exchange it for something that is much lower risk and has not moved at all, basically. So that's just the way things are. The market is the market. This is the transaction. I did think about splitting it and buying some more Century aluminum, but it was only 2,600, so I didn't want to get fancy. There was also some consideration here about whether CNX should also go to get out of the position and go into Cabot, but then I reflected and I was thinking about the positive of the hedge book of CNX is heavily underwater, meaning that if the natural gas price fell, then CNX their earnings potential for the year would not be impacted very much. It'd be a minor impact, and since they're underwater, you've got like a lot of leeway and for the natural gas price to fall before it becomes a detriment to the shareholders, and that is obviously something you don't have with Cabot Oil and Gas. Cabot Oil and Gas is pretty much unhedged. They don't need to hedge. They are very low risk, very low cost. CNX is also low cost, but they have some significant debt relative to their market cap, and as a consequence, they're playing it safe, to repay that debt, and then once they repay the debt, we'll see what they'll do. But with CNX, there's also one big benefit, and that is the fact that the management has been bearish on natural gas price, which is of course why they are so heavily hedged. Maybe they're just talking their book, but they've said that they won't be increasing production, which is something that when you're looking at the prices rising is kind of a head scratcher, because you're like looking at it and thinking the market is incentivizing you to produce more. Why are you not producing more? So I think there could be a moment of truth where they just admit that they're wrong about the outlook, the near-term outlook, and they just say, well, the market is saying they want more natural gas, and they'll just increase their production for the current year at least, and and then they could add in a lot of additional earnings and positive gains and profits for the shareholders, and that would be a very good thing. But on the downside, there is the only risk I really see is that what could happen is that the natural gas price just gets too high, and with their hedge book, that they might be in a position where they would have to cover some of their shorts against the against the natural gas price, which is odd because they're hedging their production. They're going to produce it and they're selling it forward, so you'd think there shouldn't be really any risk. But these sometimes these companies, they just get themselves over exposed, and the margin clerk says, hey, you know, you're out of steam, you need to pay up, and you know, it's the market, and that's the way it goes. Yeah, I'm not going to talk about anything else. Safe Bulkers did have a meltdown during the day. I'm going to have to reevaluate whether these two companies here are overvalued on a replacement cost basis, and if they are, then there might be a case to reduce the positions, and if not, then who cares. But yeah, we're going to see here, of course, overall what happens. The 1 year anniversary is only 3 days away on Thursday. I'll post here what the gain was. This was a starting capital. I've also moved down this here a bit because as I keep going lower and lower, I'm going to lose this out of sight, so I've just decided to push this down a little bit here. And yeah, that's how it is. So I'm going to end the video here. Remember, as always, it's not investment advice or recommendations to buy. Copy me. I could be wrong on things. I could be, of course, I could be right. I mean, the recent past has shown that I've been more right than wrong. Obviously, I've been wrong here, and so far I've been wrong here. These two here have not worked out yet, but you know, it's not down by much. It's only a few percentage points, and the upside is there. So we'll see how this ends. So yeah, gonna leave it there. Have a good day.